Okay, this is week 12 of the program, so we're almost at the end. This week and next are the last two sessions are closely associated, closely related. We're going to cover interest rate, derivatives, and credit. Okay, so these are two topics that are quite closely related to each other, and they're enormous topics. Okay, interest rate and credit can be a module in its own right. Okay, I could spend 13 weeks just talking about interest rates and credit. It's that big. Okay, so in this program, we're just going to skim the surface. I'm going to give you an introduction to the basic models, and even then, we won't cover everything. We'll just cover the introductory models. It's more to give you an idea of what's out there. I believe in the past there used to be a program, an elective that you could take which covered interest rates and credit in more detail. I don't know. Is that still available? Yeah? QF5209? But anyway, it's still there. So if any of you decide to take that program, you're going to cover all of these topics and a lot more in a lot more detail. So this week and next is really just about giving you an introduction. If you ask me, the way I prepared the following 2 weeks is more kind of like an introduction to anybody who's interested in taking that elective. Okay? So I'm going to start off by talking a little bit about an introduction to interest rates. Okay, since it's such a big topic, interest rates were introduced to you on day one of this program, and we kind of just put it to one side since then, right? But it's been in every single lecture since day one. Okay, we created the money market account, we made interest rates deterministic, and we kind of just forgot about it. Okay, but it's been there. The reality is that interest rates are random themselves. Okay, so today we'll start to talk about what are the implications of that randomness. But really, before I even start talking about maths, I'm going to spend maybe 10 minutes or so just talking a little bit about economics. Okay, about what interest rates are, why they exist, give you a bit of a broader picture. And then we'll go into interest rate modeling. And I will talk about the three models. There's one more in there, the Holy model, which we'll talk about. But they're basically one-factor interest rate models. Okay? I'm going to talk about the parallels between interest rate modeling and everything we've done up until now, which let's call single asset modeling, whether it's equity, whether it's FX. We've kind of always followed the same path, right? You derived the PDE. The symbols were different, and maybe you had some additional terms, but the philosophy was always the same, okay? And mathematically, the machinery was always the same. Today, the philosophy stays the same, but it's a little bit more complicated, okay? So we're going to go back to basics in terms of derivative pricing. We're going to rederive the PDE, rederive an expectation, okay? You'll see that it all still looks familiar, but the process of getting there is a little bit more complicated, more involved. I'll today also introduce the basic instruments, the zero coupon bond, bonds in general. Bonds are a huge market in the fixed income world. Floating rate notes, forward rate agreements, floating rate notes, and we'll also talk about options. Okay, so for the purpose of this module, this session today, and for more importantly for the purposes of like the exam and types of questions that can come up, you'll see very soon that the expressions are much, much more complicated. Okay? Even though they look similar, solving them is a lot more complicated. So I'm going to take it as far as building the expression for an expectation, but I'm not going to solve it. Okay? I'm not going to solve it because it's very complicated. I'm not going to solve it because you will not be expected to solve it in an exam. And third and most importantly, that's not how anyone would solve it anyway. Okay? If you want to know how they're actually solved, take the elective. Okay? But we'll get as far as computing an expectation. Okay? And computing an expectation is always useful because you've got Monte Carlo at the very least, right? You can run a Monte Carlo simulation to compute any expectation. Next week we'll introduce credit swaps, credit risk, more broadly, swaps, swaptions. We'll talk about this topic, zero curve bootstrapping. So bootstrapping's come up a couple of times already. when we bootstrap forward volatility. There was a question on the midterm on that. Today we'll talk about zero curve bootstrapping and also forward rate. So forward rate agreements are essentially just a bootstrapping of the zero curve. Okay, and I'll introduce all of these terms as we go along. Okay, so to start off with, let's just, this part is more background information. Okay, it's to help you understand the bigger picture. It's more of an economics, macroeconomic overture than a deep mathematical kind of talk. But okay, what are interest rates? Okay, and you know what they are. It's what you get paid when you put money in a bank. Or if you need to borrow money, it's what you pay kind of as a cost of capital, cost of cash. Okay? But here's a question. Before I ask the deeper question as to why interest rates exist, how many different types of interest rates do you get exposed to? Several, right? Depending on the context. You put your money in a bank, you might get 1%, if that. You borrow from a bank, and it really depends what you're borrowing for. If it's a personal loan, 5%, 6%. If it's for a mortgage, they look at your individual circumstances. Some people pay more than others. Your credit card bill, that's an astronomical level of interest that you pay. So there are many, many different types of interest rates. And maybe we need to talk about that first, because what are we talking about here? Which interest rate? It's complicated, right? There are too many. Before we start modeling, we need to be very clear what we're modeling about, what we're modeling. Okay? So the question around why there are so many different interest rates in terms of credit card versus what you get in a bank, or person A versus person B. One person pays 4%, one person pays 5%. What's actually happening is that the interest rate incorporates the risk associated with making the loan, right? If you want to borrow money to buy a house, they assess you, right? The bank looks at your circumstances, the security of your job, and they decide accordingly what to offer you in terms of an interest rate. Embedded within that is the credit element. Okay? Credit risk is the risk that you don't make good on your loan, that you run away with the money, that you lose your job and not able to pay back. Okay, so there's a credit risk element here. But for today's session, I'm going to try to strip out that credit risk. Okay? For today's session, we're going to assume that risk of default, that is making a loan and the person not paying back, isn't a risk. It doesn't exist. That's not possible. Okay? It's a credit risk-free world. Okay? But even in that world, there is such a thing as interest rate. Okay? So interest rate is normally associated with credit risk, but even in a credit risk-free world, there is a concept of interest rates. When we derived Black-Scholes, we introduced the money market account. We didn't talk about credit risk, we didn't talk about default, but the money market account still existed. Why? Why is there, I don't know if you have thought about it, but why is there such a thing as interest rate? One argument you might think of is, if you remember a couple of weeks back, when I talked about correlation, I drew the banking model for you, right? Banks, investors deposit money, people who want to borrow take money out, the borrowers pay more interest than the bank pays to the depositors, and the bank makes money that way. That's part of the answer. Okay? You can argue that interest rates exist because banks are trying to entice people to save money with them. More people that save with a bank, the more money that bank has to then make further loans. Okay, that's partly true. But why would investors put money in a bank in the first place? Why would investors put money in a bank in the first place? What's the other topic that always comes up with interest rates? And if you've been following macroeconomic news, especially the last year or so, exactly, inflation. There's this thing called inflation, and we all know it exists. We all witness it. Prices go up every year. Why? Why do we have inflation? Or rather, where does it come from? We all accept it. I don't know if you ever thought about it, but why is there such a thing as inflation? Where does it come from? Is it just an unfortunate consequence of life? It's there. And even if that's the case, why? Why can't prices just stay the same? So let's put that to one side for a moment, okay? But if we accept inflation, okay, and inflation is going to turn out it's something that's engineered into the system, right? It's intentional. But if we accept that there's such a thing as inflation, then what does that mean for money? It means money is a commodity that's just going to devalue, right, forever. That's not very good. Okay. That's not a very good commodity. It's not a very good asset. Interest rates are compensation for inflation. Okay? So interest rates are compensation for inflation. So we've understood interest rates, but we've only understood it in the context of something else we now don't understand, which is inflation. So why do we have inflation? I said earlier that it's not an accident. It's not something that exists because nobody controls it. It's actually engineered into the system. And if you've read financial news, you always hear this number, 2%, right? Central banks, they're aiming for a 2% target. Anything too high, that's no good. Below 2%, that's not good either, right? They're aiming for 2%. The 2% number turns out to be arbitrary, right? That's just a number somebody came up with at some point and decided that a 2% rate of inflation is good. That's what we should aim for. But why? Why do you think they engineered it that way? To understand that, we really have to talk about money, okay? Because inflation is the deterioration in the value of money. Interest rate is kind of the cost of money, right? So what is money? Where does money come from? Right? It's something you've maybe never even thought about it, right? People take money at face value, literally. Okay? I have a daughter. Okay, she's 6 now, so she's starting to understand the world a bit more. But even when she was 3 years old, she couldn't say a single word. But she knew about the existence of money, right? She knew there are these colorful pieces of paper. You go to the shop, just hand them over, and you get something you really want in return. Okay? Get a toy that you really want. You don't care about the paper, but you get something you really want. Have you ever thought about how that works? Like why it even works? Like part of the reason is it works because everybody says it works, but why does it really work? Where does the money come from? Does anybody know? Right, the central bank creates the money. Okay, and what is money, if we were to define it? Okay, perfect. There are usually 3 definitions. One is a unit of value, which is a unit of currency, like a unit of measurement. Okay? Any others? Sorry, a
Receipt of some other assets like gold.
store of wealth?
Yes.
Okay, yeah, store of wealth. Because people, what do they really care about? If you think of a very primitive society, they just want food, they want basic goods and services. If they had a lot of wealth, they put it all in food, there's a problem, food goes off, and you lose all your wealth. Right? Money is kind of a store of wealth. It allows you to hold on to that value longer. Okay? So we've had unit of account, store of wealth, and most important one.
Medium of exchange.
Yeah, exactly. Medium of exchange. It's a way of transferring wealth, okay, to buy goods and services. So the central bank creates money primarily, or one of the big reasons, to offer people a means of exchange. Okay? Gives them a way of exchanging goods and services. Now, how much money do they need to release? It really depends on how many goods and services there are out there. More goods and services, you need more money. Okay? It's not the money that makes us rich, it's the goods and services, right? It just so happens that when we all have more goods and services, there's more money. Because money is nothing more than the thing we use to exchange those goods and services. So the central bank is really responsible for the growth of the economy. Okay? And by growth of the economy, I really mean the amount of goods and services that exist. Okay? That's the mandate of the central bank. It's to ensure the growth of the economy. There's one caveat: by keeping inflation under control. Okay? Now you can see if the central bank just printed money and created too much, there's a problem. There's too much money. And if there's too much money, then people are going to have more of it. They're going to be prepared to part with more of it just to pay for the same goods and services. That's inflation. Right? So the central bank has to be very careful about how it orchestrates the creation and circulation of new money. Okay? It does it naturally. Right? It does it naturally because the supply of money has to grow, because the economy has to grow, and the economy has to grow, one, because we all want to feel better off, but even without all feeling better off, the population's growing. So we just need more goods and services to cater towards more people. More goods and services means more money. Okay, so the central bank has to orchestrate this creation and circulation of money. And if they create too much, which is very natural, it's actually natural to create too much, right? How do we create more goods and services? We build more factories, build bridges to connect people, to go to work in those factories. Now you have to create the money today so that the people can be paid to start work on all of these factories today. The goods will come later. Okay, so one of the reasons we have inflation is because you release all this money a priori, beforehand. And that creates some inflation. The goods and services come later. And the idea is that things readjust, but it's perpetual, it keeps happening. Okay? So it's a huge, huge topic. What money is, where it comes from, why there's inflation. Okay, I've just explained to you where it comes from, and it's unavoidable. Another reason, the real reason we have inflation, what I just described in terms of releasing the money before it's being used, that's kind of just a more mechanical reason. One of the reasons is central banks want there to be inflation in the economy. They want the value of your money to deteriorate. Okay? And they want that because any rational person would go and put their money in a bank to stop it from deteriorating. What's the difference between you holding onto your cash at home and money in a bank? Interest rates, sorry, the other one? Yeah, loans, kind of. Exactly, it's in circulation. Money sitting at home under your mattress isn't doing anything. Okay? Money in a bank means it's available to lend out. And that's good, because people have good ideas. Somebody has a great idea to build the next generation iPhone. They need cash. You all agree the next generation iPhone is good for all of us. Okay? People want to build businesses. Well, businesses provide goods and services. That's good for all of us. That's only possible if the money's in circulation. If it's not in circulation, no loans. No loans, no businesses, no entrepreneurs. Okay, so inflation is kind of the starting shot that forces you to put money in a bank. Once it's in a bank, it's in circulation. Once it's in circulation, more goods and services come online. And that's the mandate of the central bank, to create goods and services, to expand the global economy, but in a way that does not cause too much inflation. Okay? That's the big picture. I'm not going to talk about it in any more detail. What I'll do is, there's an essay which talks about all of these ideas in a bit more detail. It's about a 20-page essay. You can read it over a weekend. It is not part of this course. Okay? So I'll make it available to everyone. Get your exams out of the way. At some point, come back and read through it, but it will give you a whole picture of the economy. Macroeconomics, the idea of central banks, the idea of commercial banks, the idea of government, what taxes are. Okay? Even the question of what taxes are, people have it backwards. People think taxes are the way governments raise money so that they can spend. Okay? It's an outdated view. So this thing called modern monetary theory which says that really the whole point of all of this is to ensure money keeps flowing around in the economy. Okay, so anyway, it's not part of 5209, but it really is the macroeconomic background as to what we're talking about here. Okay, so you understand now, or at least broadly, what interest rates are, why they exist. It's a huge market, given that this is what spins the economy. Okay? And there's one rate, the central bank rate. Okay? The central bank sets a base rate. That is what we will call the risk-free rate. Okay? The central bank rate, essentially, if you want to go into a little bit more detail, it's the rate that Bank A, JP Morgan, would lend to Bank B, Morgan Stanley, at the end of every day on kind of a overnight basis. It's generally unsecured, so there is a little bit of risk, but it's tiny, given that these big organizations aren't going to default overnight. Okay, so there's one rate. And the central bank rate then triggers the savings rates, triggers the mortgage rates, it triggers the credit card rates. They're all connected. They're all connected to the central bank rate. Okay, so we talked about why rates exist, who controls them. There is a credit risk embedded, but we're stripping that out today. Okay, so for the rest of today, no credit risk. Everything we're talking about is a safe world where nobody's going to run away, nobody's going to default on loans, but we still have interest rates. Okay, so I think this is the Federal Reserve rate for the last, since the 1950s. Okay. This is the risk-free rate that we're talking about. So, it's clearly stochastic, right? It's clearly stochastic. It goes up and down depending on the economy, depending on the decisions central banks make. But it's range-bound, okay? If I were to plot an equity price, or S&P, or NASDAQ on this chart, what do you think you'd see? Just something like that, right? Equity clearly isn't bounded in that sense. It just keeps increasing. Okay? And part of the reason is inflation, right? It measures the value of something, so it's got to keep increasing. Interest rates just look like they're kind of bouncing around at some level. Okay? And we'll talk about this in a few slides. Interest rates aren't an asset, they're a concept. Okay? Which is why it's just range-bound. So a good model would be a Gaussian model. Okay? Because interest rates can be negative. It hasn't turned negative in the US, but in Japan for the last 30 years, if you take away this year, they were pretty much negative. And in the Eurozone, I think there was a period around the Greek debt crisis where it turned negative. Okay? So interest rates can be negative. And a Gaussian model admits negative values for the underlying. Right? And that's what we're going to see. I haven't introduced any models yet, but the three models I will introduce are all Gaussian models. Okay, so interest rates are stochastic. Now, what does that mean for everything we've done? Day one, we introduced the idea of a money market account. Okay, money market account's still valid. We're not going to change that. Okay, a money market account is, in this course, as close to the real world as we can get. Right? You put your money in an account, it grows. That's the money market account. So that's not going to change. What will change is that R is now stochastic. Okay? R is stochastic. It can change, and it can change unpredictably, which means that the money market asset, BT, is also stochastic. Okay? Here. That's the dynamics for BT. There's no Brownian motion, but it's stochastic. Why? Because R is stochastic. Okay, so we need a model for R. We need a process for R. If we accept for the moment that R is going to tick randomly from one time step to the next, you can see why B would be stochastic, right? The drift is stochastic. So whether it goes up or down is determined by R. Now, what does this mean for everything we've done? Right? It's week 12, and I'm telling you, money market account's gone. It's not gone, but remember we had under the risk neutral measure, right, which we always called e to the minus rt minus t. Okay, that doesn't mean anything anymore. Okay, that doesn't mean anything anymore because r is stochastic. What does that even mean? We can't price our derivative that way in a stochastic world. So am I trashing everything we've done? Am I telling you now that it was all a bad dream? It depends on context. Okay? It depends on what time horizon you're in. If you're pricing, because what you can see, it's very clear on this chart, interest rates change, but they go through periods where they don't change all that much. Okay? If you're pricing an option and you're kind of here around 2010, pricing a 1-month option on equity, rates aren't changing much. You're probably okay to make that assumption that interest rates are deterministic. Okay? It depends on what you're pricing. If you're pricing a derivative on interest rates, then you definitely want to make rates stochastic. Okay? What market are you in? If you're in this market where rates are coming down or this market where rates are going up, you really can't assume rates are constant, right? You're going to get these shocks. Remember, if you assume rates are constant, you're making R a parameter. And if you make R a parameter, any jumps in R are going to cause these discontinuities in the price, right? Which you will experience as a trader when you hedge it. Okay, so there's a question on the midterm. You're a trader, you sell a call option, blah, blah, blah. I think one of the last ones was what happens if the volatility shoots up? Well, somebody makes or loses money in that scenario. Okay, I can't remember the details of what the answer was, but if you assume volatility is a parameter, and then halfway through you change it, you've broken your model. Same with interest rates. You assume it's constant 5%, halfway through the hedging, it moves, it's out of your control, right? It's market observable, central bank decides to increase it, you have a problem. One party, either the bank or the client, will make or lose money, right? What one party makes, the other one loses. Okay, so it's the same idea as like changing the Black-Scholes vol. We have to be very careful if we want to keep R as a parameter. Okay, so we're going to introduce something called the instantaneous short rate, RT. Okay? You can think of this as just being the interest rate that you get overnight. Okay? It's the limit of infinitesimal time, but overnight. Log normal fails. Two reasons really. Rates don't behave log normally. They can take on negative numbers. And it won't be obvious to you from anything we do in this course, but a log normal model for rates can result in explosions in the value of the money market account. Okay? You're taking the exponential of something log normal. There's a lemma out there that says that under certain circumstances that quantity can explode numerically. So from a numerical tractability perspective, log normal doesn't work either. Okay, so we're going to go with Gaussian rates, and here are the three rates. Something called the Holy model, which is it's the simplest thing we can do. Okay, constant drift, constant vol. Okay, it's not log normal, it's Gaussian. A Vasicek model. Have you all come across the Ornstein-Uhlenbeck process? One nod. I would have expected Introduction to Quantitative Finance to maybe introduce that at some point, yeah? Okay, so we use an OU process for R, okay? And there's some parameters, a theta, alpha, still sigma's the volatility is still there. Okay, so that's one model. Hull-White is identical to Vasicek with the difference that the parameters are all time dependent. That's all that changes. Okay? And very, very often, under the Hull-White, this is the alpha parameter, which is the mean reversion parameter. It's just kept constant. Okay? And in many cases, this is also kept constant. The really important one is this parameter. It's made time dependent. Okay? And we'll see why that's important. We'll end up using this model, not Vasicek, because we need a time dependent drift there. Okay, so notice about these two models that we have something called the mean reversion rate. Okay? How would you describe theta? Theta is the mean reversion level. So theta is some level. If r goes above theta, this becomes negative. Okay, if it's negative, the dynamics bring it back down. Okay, so it stops r going too far away from theta. The strength with which it brings it down is alpha. So we call this the mean reversion level, this the mean reversion rate. Okay, so let's, just for clarity, mean reversion level. What's going on here? And mean reversion rate or speed. It's also called the speed of mean reversion. Okay, higher alpha means it really brings back any deviations in r away from theta. Okay, so I'm going to go through the models one at a time. Wholly is very easy. There's really nothing to talk about, right? It's very straightforward. You just do an integration. The first term, if mu is constant, it comes out. Otherwise, you integrate it, and you've got Brownian motion. Okay? So it's very clear. This is the mean. And this thing here is the variance, right? And you all know by now, sigma times Brownian motion is a random quantity with mean 0, and volatility sigma squared times time, right? Time horizon. You can think of mu as being kind of the rate of change of interest. Okay, if you have a view as to where interest rates will be in the future. Okay, maybe you know that the Federal Reserve reduced rates about a week ago. Maybe you think they'll reduce them again in 2 months. So you use mu to adjust for that. Okay, so mu would be some negative number. R is what the rate is today. The important thing is that the model is Gaussian in short rate. Okay, R is a Gaussian random variable. That's the model we've chosen. That's the Wholly model. And I've actually never seen the Wholly model used much, but I will keep coming back to it because it's really good to demonstrate concepts. It's very simple. Okay, the model that people use a lot it's not even this one, it's Hull-White, but Hull-White is an extension to Vasicek. Okay, so you have the Ornstein-Uhlenbeck process. We'll see that theta is the mean reversion rate. It's a long-term level of rates. We'll see why that is in a second. Alpha is the speed of mean reversion. Now this is unlike, if you've never seen an Ornstein-Uhlenbeck process before, this is a little bit weird. Okay? It's not quite like any other model we've seen. We've seen the pure Gaussian, like Wholly, and we've seen the log normal. Okay? So this part here looks a little bit like it's Gaussian. This part here maybe makes you feel it's a bit log normal. Okay? It's actually a pure Gaussian model. And to see that, you need to solve this stochastic differential equation, which you should all be able to do. Okay? You should be able to derive the solution to an Ornstein-Uhlenbeck process for the exam. For those of you going into quant finance, this comes up a lot in interviews. Okay? It's a very common interview question here. Here's a process, can you solve it? Turns out to be an OU process. Okay? It's not hard. I'll go through it slowly. I'll let you go through it in detail in your own time if you haven't seen it before. You take this term, put it to the other side. Okay, step one. You use the concept of an integration factor or integrating factor. Okay, for those of you who've done a bit of calculus, It's just basically you multiply throughout by e to the alpha t. Okay, it's a trick. If you multiply everything by e to the alpha t, you notice that everything on the left can be written like that. Okay, if you expand that, you get r times the derivative of e to the at alpha t plus e to the alpha t times derivative of r, which is exactly what you have at the top with the integrating factor. Okay? And everything on the right, if you do an integral, is pretty straightforward because they're all functions of time. Okay? In this case, theta is a constant, alpha is a constant, sigma is a constant, so a lot of terms can come out of the integration. What's important is that you end up with something like this, which you can rearrange to this. And you should all understand the terms here. Okay? Nothing complicated here. This is just some messy looking constant. And you all have seen something like this before. Okay? It's an Ito integral, which means you understand what this is. It's a random component. It's normally distributed. You know the mean. You compute the variance. How would you compute the variance? What's the lemma? Ito isometry, right? Whenever you see anything like this, you can understand it, and you know the integrand is well behaved. It's just exponential. Anytime you see anything like this, you understand it straight away. Think of it as a Gaussian random variable. All you need to worry about is what's the mean. Well, it's 0 in this case, in all cases of Brownian motion. And then what's the variance? Use Ito isometry. Okay, so Ito isometry. And again, Ito isometry will come up somewhere on the exam, right? I don't have to hide that fact. Okay, so this is the mean. This is kind of that's where the distribution is centered, right? I hope you see that RT is Gaussian because it's a constant plus a Gaussian random variable. Okay, there are the properties. And what's interesting is what happens as big T, your time horizon, goes to infinity. Okay, let's just study that case. Well, this term dies, right? E to the minus infinity. That term dies, and you're left with theta. Okay, which kind of makes sense. Theta is the long-term level. Okay, we're not saying that rates go to theta. We're saying the mean goes to theta. Okay, rates are still some distribution, but they're centered on theta. What happens to the variance? Okay, so maybe an exercise for you. Make sure you can go from there to there. That is Ito isometry. Some of you might have done it already on the side. As theta goes to infinity, that term there goes to 0. You're left with sigma squared over 2 alpha. Right? This is different to other distributions we've looked at. Other distributions have said that the further out in time you go, the wider the distribution comes. Okay? What stops that happening here is the mean reversion. Okay? Because we have this force bringing things back into line. As mean reversion goes to 0, that becomes infinite. Okay? So it's all kind of consistent with other things we've seen, but it's an interesting result. The variance is bounded in this case. Okay, any questions on this? The important takeaway is RT, which is the integral of RS ds, is Gaussian. Okay, Holy was Gaussian as well. Okay, look, there's nothing different here. I've kept this constant. I've made this time dependent. The important one is this, for reasons we'll see in a few slides. The level of rates is time dependent. Now, you can see why you would want to do this from a practical perspective. Okay? As time goes, as you go out in time, you have different expectations for the interest rate will be. Okay? If you're in a rate increasing regime, you know rates are going to go up, but at some point they'll stagnate and they'll probably come back down. Okay? So you'll want to have a varying function, time varying function for the level. Okay, so it makes sense. Okay, and I won't do the maths again, but definitely go through it. All the changes is that these terms, this theta term no longer comes out of the integral, stays in the integral. The variance looks a little bit more complicated now, only because there's more terms in the integration. Okay. More likely, in an exam setting, I'll make sigma constant, I'll make alpha constant. Otherwise, the calculus is just too messy, right? But go over it. Very often, you do see time-dependent functions of sigma and alpha. Okay, any questions on the three models? Anything? Okay, let's talk about some of the assets in the interest rate world. Okay, because I've introduced R, but R is not an asset. Okay, interest rate is just a feature, a property of the market. You can't buy and sell R like you can buy and sell S, which was our stock, or X, which was our FX foreign currency. Okay, R it's interest rate. You cannot take a position. It's not a tradable. We're going to have to introduce this concept of a zero coupon bond, okay, which is really nothing more than the simplest derivative that we talked about on day one, a promise to receive $1 at some time horizon, capital T. Okay. Previously, when rates are deterministic, there's a very simple, no arbitrage hedging argument you could use to come up with what that discount factor should look like. Okay, we don't have that yet. Okay, but let's assume they exist. So I'm going to assume that zero coupon bonds exist. Okay, we have the value of receiving, the fair value of receiving $1 at some time horizon. Okay, that means if you have $1 to invest today, you buy this many units of the bond. Okay, and you get that capital at the end. So your $1 goes from $1 to whatever that is. If Z is 0.9 or 0.95, because interest rates are kind of like 5% at the moment, your $1 grows to about 1.05 over a year. Okay? We definitely can't say this. Okay? We can't say that. That doesn't even make any sense. This term on the right is stochastic. Okay? It is using, if I were to use stochastic calculus terminology, this is Ft, capital T, measurable. Okay? You don't know it at time little t. So I can't price a bond at time little t, which is going to pay $1 capital T using this term. Okay? This is now nothing more than a function of a stochastic process. It is not Z. Okay? We'll derive what it is. But now assume it just exists, right? Assume we had Z. Assume we had Z in the same way that on day one of the course we assumed the existence of S. Okay? We didn't question where the stock price came from. It exists in the market, right? We're going to show that that's actually what's going on here. In the world of interest rates, Z is our S. Okay, just let that sit with you for a little bit, and I'll come back to it. Okay, so we need to understand Z. Now you might think, well, can I take some average of all the possible paths based on R? Turns out we do something very similar to that. Okay, but we need to build the machinery to understand exactly what's going on. But yeah, you can think of it as, if interest rates are random, if I average out all the randomness, kind of where am I? Yeah, that's roughly what's going on. But again, I don't want to talk about that too much. I want to introduce the product. Okay? And the most important product, or the most basic product in fixed income markets, okay, fixed income interest rate markets, is the fixed coupon bond. Okay? Which I hope you would have all heard about. But I'll introduce what it is here. It's a staple investment. You know, most money managers or asset managers use the 60-40 rule, which says take 60% of your cash that you want to invest, put 60% in equity, 40% in bonds. Okay? Because the bonds are very stable. Okay? That's not to say they don't move around, but they're much, much more stable than equity. So rule of thumb, you could say that 40% of all investments out there are in these fixed coupon bonds. Okay? It's a big number. I'm going to use P to denote the price of a fixed coupon bond. Okay? And what is it? If this is today, and you have these dates in the future, all the way up, let's say to TN, a bond is nothing more than pays you a coupon on each one of these dates, and then pays you your notional face value right at the end. Okay? So a bond always has associated with it a face value, usually $100. You get C% on each one of these dates. Okay, so if C is 5%, you get $5 on each one of those dates as an investor in this bond, right? So you pay for it on day one. And if you pay for it on day one, it entitles you to get all of these coupons, fixed cash flows. You know what it is. C is a property of the bond. And you get $100 back at TN. Okay? So at TN, you'll get, let's call it 100 plus C. Okay? You still get a coupon. You also get your $100 back. That's the cash flow. What's the fair value of this? We think of it as a derivative. Well, it's actually just a linear combination of fixed cash flows. What is the value of a fixed cash flow in terms of the zero coupon bond? Remember, previously we said a fixed value has value today e to the minus RT. Okay, but we're not in that world anymore. E to the minus RT got replaced by these Z's. Okay, which I haven't yet described where they come from, but we've assumed they exist. Okay, so Z is basically nothing more than the discount factor. It's a promise to receive $1 at capital TI. Okay, so then I can rewrite the price of a bond just using this summation. Does everybody see that? It's the price today. And this delta, in case you're wondering, it's just a measure of day count fraction. Okay? Because you're getting C is usually quoted as a percent. And you've got to multiply the percentage by the number of days, the time period. Longer time period, more coupon. The day count fraction is very important. You need to understand, you know, maybe these two. Actual 360, actual 365. It's just a way of measuring the size of a time window. Okay? Okay, but more importantly, this is it. This is the expression for a fixed coupon bond. Any question on that? Because we're going to go a bit deeper into this now. Why do these bonds exist? Anybody know? Where do they come from? Louder? Loans, yeah. By who? Yeah, exactly. That's all it is. If companies need to raise capital because, I don't know, let's say they're building the next generation iPhone. Okay, they need a lot of capital for all the research, for all the investments. They have two avenues, right? One is they sell shares. Okay, they sell ownership in the company. And investors come along, pile money in, and they get an ownership of the company. The company gets the cash to do the research. The other choice is they issue debt. They issue bonds, which is what's going on here, right? So the investors come in, they don't get an ownership of the company. They're basically making a loan. Okay? So the company borrows the money, $100 on day one, agrees to pay back C% every year for the next 10 years or next 5 years, whatever it is. Okay, so that's what we're talking about. That's why we have bonds. That's the bond market. And typically, we say that the bond is issued at par. Okay? That just means at a time t0, when the bond comes into existence. Okay? That's the day when I come to the market and I say, I'm Apple, I need to borrow some cash, I need 100 million. Okay? And all the investors come in and they buy the bond. They buy it for $100 per bond, okay? Or one. It's just a scaling. Right? At par just means they get $1, they invest $1. But from one day to the next, the value of the bond can now move. Okay? It can go above 1, it can go below 1. It can never be negative. Do you see that? Bond price can't be negative. What if the bond price was negative? What does it mean? Who loses money? Yeah. Well, as an investor, if an asset costs negative, it means someone's paying you to take it. So if a bond price is negative, you're being paid to take it. Then you're going to receive a nice stream of C cash flows, and you're going to get 100 at the end. You know, it's too good to be true. Of course it is. So it's never negative. But it can fluctuate up and above 1 or below 1. And usually, as it goes to 0, it usually means one thing. Okay? It usually means the company's distressed, there's problems. It's credit. Credit risk comes in. Okay? So that's for next week. But for now, we're going to assume that we're talking about a bond issued by a very trustworthy agency. Who's the biggest issuer of bonds? The Fed, right? The government, really. If we're in a certain currency in a certain country, the country of that government is the biggest issuer of bonds. Okay? So you're talking about bonds that are being issued by the government. So you think they're pretty safe, right? They're not going to crash to 0. The point is here. So when the bonds are issued on day 1, that's when the coupon gets agreed. Okay? And remember, we're now talking about risk-free bonds. We're talking about that base rate of interest that always exists. Okay? So C. Okay, so C is set at issuance. And C represents the average interest rate from 0 to Tn. Okay? This is in a world where the government is truly default risk-free. Okay? That would define the average interest rate for that period. And because it's being issued by a body that's risk-free, that interest rate is risk-free. It's kind of our base risk-free rate of interest. I'm simplifying a little bit here, but let's keep going. So the point is, if the market thinks interest rates are C between today and, let's call Tn 5 years, that view can change day to day, right? If anything, the Fed can come along and say, you know what, we're going to change rates out of the blue. That can happen. Very rare, but it can happen. Nobody knows for sure when the Fed will raise. There's a lot of speculation. So this C is just a view. It gets locked into the price of the bond, but at this point in time, it's just a view, and it's the market's view. So when we say that the value of the bond can increase or decrease, it usually means that the interest rate is moving in the other direction. Okay? Let's see why that's the case. So I'm going to take a very hypothetical example, extreme example. Let's say today we're in the market, everybody expects C, the rate of interest, over the next year, 2 years, whatever, Tn, to be 3%. That's what we all expect. Government comes along, issues the bond at par, P equals 1, and they lock in C. Okay, so they issue a bond where the terms of the bond say that the coupon is 3%. That's not going to change now, right? That's property of the bond. 2 hours later, central bank comes knocking and says, you know what, we're increasing rates. 5%. right? It's not realistic. I'm just giving you the economics of what's going on. Right, so government comes back later that afternoon, needs to issue some more bonds. What are they going to issue them at now? 5%. Okay? What about all those other bonds that were issued at 3%? It's got to depreciate, right? If you're an investor, because these bonds, once they're bought and sold from once they're bought from the government, they can be bought and sold on the open market. If you're an investor who wants to invest in bonds, you see a 3% bond, a 5% bond, which one are you going to buy? Who would rather get the 5% bond? No, but now let's say I'm a neutral investor who never got involved in either of the rounds of financing. Okay, there were two auctions. That's what it's called when the government raises money. In one auction, they they locked in a 3%. The other, they all locked in a 5%. Investors bought them all up. I'm now a third investor who missed out of both auctions, but I want to buy the bonds on the open market, and they're both being bought and sold. If you are one such investor, would you rather have the 5% bond or the 3% bond? You would rather have the 5% bond, okay?
Your risk appetite as well. Because 3%, if it goes down, you're willing to buy it cheap.
Yeah, I think you're on the right lines. The important point is that it doesn't matter. It shouldn't matter. Okay? Nobody, all else equal, would rather have the 3% bond or the 5% bond over the 5% bond. All else equal. The point is that it's not all else equal. The value of the 3% bond has to go down. Okay? So if you're a third investor, how much would you buy the 5% bond at? $100, right? They just auctioned it at 100, so it's probably around 100. And you'll get 5%. What if somebody offered you the bond that pays 3% at 90? Yeah, you get 3% less, but now you're only spending 90, you're still going to get the 100 at the end. There's a sweet spot, basically, where the 3% would adjust to an equilibrium where you become indifferent. Okay? Now, how do we formalize that? The answer to this question is no. But how do we formalize, how do we compare two of these bonds? And this is the term that we want to introduce. It's called the yield to maturity. Okay? The yield to maturity is nothing more than the solution, the value of y, that satisfies that equation. Okay? You know the price of the bond, they're trading on the market. You know the TI, etc. You know C. C is a property of the bond. Okay? You need to solve for y, and you need to solve it numerically. Okay? You can't do this, you can't invert it just by using any fancy calculus. You've got to do it numerically. Okay? A good question would be, write an algorithm to extract y from the price of a bond. You've all seen algorithms to extract sigma from the price of an option. Okay? Maybe there's something similar you could do here. Mathematically, they're identical. Right? It's a root-finding algorithm. So you've got two bonds in the market, one that pays C equals 3%, one that pays C equals 5%. They each have their own prices. What you will find is that the yield to maturity of a 3% bond and the 5% bond are identical in this example that I've mentioned, because the dates all align, they're all perfectly aligned. It's an idealized example. But you'll find that y should be the same, because y represents your return for investing in the government. Okay? Now, what if they weren't the same? Arbitrage, right? You buy which one would you buy? Let's say one has a slightly higher yield to maturity of the other. Yeah, exactly. The difference in the price will be your kind of risk-free profit. Okay, and the yield to maturity is a proxy for the expected rate of interest over the life of the bond. Okay, so let's be very clear. C gets set on day one. On day one, because the bond is issued at par, C also represents the yield to maturity. Okay? After that, it changes. C stays the same. The price of the bond changes from one day to the next. But the yield to maturity also changes to reflect the bond price. And the yield to maturity is the market's view as to what the risk-free interest is. Okay? So it changes daily. And that's really the randomness that we're talking about. Okay? In very basic terms, that's the randomness. Okay, let's take a short break. It's been an hour already. 15 minutes, we start again at 1:15. Any questions? If no, then let's start in 15 minutes at 1:15. All right. Any questions on the fixed coupon bond? Okay, so the important parts, I want you to understand that you can extract a yield to maturity from the price of a fixed coupon bond. That yield to maturity really tells you the implicit rate of interest that's offered by the bond. You need to extract it numerically. I want you to understand the relationship between the bond price and the rate of interest, right? And they're opposite. If rate of interest goes up, bond price has to go down. And the bond market, as I mentioned, it's such a big part of the market that people want to understand how does the price of their bond change when the yield to maturity changes. Okay? So the yield to maturity is the thing that's out of their control. It dictates the movement of the bond. Maybe that's the right way of thinking about it. And what's the yield to maturity? It's the interest rate that the market believes in, right? That the market thinks represents the time horizon. Okay, so the derivative is very straightforward. It's just apply ordinary derivative to each term, and you get this expression here, which is called the duration. Okay, it's the duration of the bond. It's just a fancy term for dp by dy. Okay, and for many reasons, but important thing is it's negative. Okay, that's exactly what you'd expect. Yield goes up, bond price goes down. Okay. There's also in the market the idea of a modified duration, which is nothing more than how does the price change as a percentage of the existing price. Okay. That's all it is. Right. Very often these two are very close to each other because P is going to be pretty close to 1. It's not going to be too far away from 1. Okay, for a risk-free bond. It can move quite far from 1 if P was issued way back when interest rates were 7%. Okay, it might be a 30-year bond. And at that point, C was something around 7%. Okay, but the current rates are 4%, so P is no longer trading at par, right? It's quite far away from par. So in that case, it might make sense to use modified duration. Okay, you want to understand how much as a percentage is my portfolio going to change in value if the yield moves up by 1 basis point. Okay, and that's actually the unit of interest rates, basis point. So 1% is 100 basis points. Okay, it's not too important for this course, but that's just the language. Okay, so we measure bond prices or interest rates in the market in terms of basis points, half a basis point even. Okay, that's how tight the market is. That's how big the positions are. A change in a percentage of a percentage is relevant to a lot of people. Right, so all of this assumed the existence of these zero coupon bonds. Okay, and in the end, it's going to turn out that these zero coupon bonds are the underlying that just exist in the market. Okay, one way or another, they're extractable from the market. In the same way that the underlying price, when we dealt with standard Black-Scholes, what I called S or X, the FX rate, that's just observed in the market. We didn't ask questions as to where it came from. That's a question for economists. Okay, is a stock valued correctly? Is the company really valued this much? That's a question for economists. Quants take that at face value and write derivatives on that asset. Okay. The parallel here is that Z is actually that asset. Okay. Now you might be wondering, well, why all this trouble? Why don't we just start with Z, come up with dynamics, and do the same thing? Okay. Well, one reason, when we talked about an asset, there was just one, right? Amazon stock, just one thing. Here we've got this whole continuum that's defined by capital T. Okay? So there's, first of all, many of them. Immediately, we're in a multidimensional world. Okay? Mathematically, we often characterize T as a continuous quantity, but realistically, the market, you might observe T1, T2, all the way up to Tn. You might observe a 6-month bond, a 3-month bond, a 1-year bond, all the way up to 30. Okay? But there's still more than one, right? There's still about, 20 of them. It's still a 20-dimensional problem right out the gate. Okay, that's one problem. We have to write down the dynamics in a clever way to incorporate all of them. Right? It turns out it's a lot easier to write down the dynamics of R, link that to the dynamics of Z, and then remember, what we're trying to do is not price Z. We've already got Z. We're trying to price derivatives on Z. We're trying to price something like an option maybe an option on Z, but maybe an option on P. Okay? We need to price an option on P. Now imagine you were pricing an option on P, and you had all of these Z's in the picture, right? There's too many of them. How are you going to price it? It's a lot easier to model R, link R somehow to all the P's, all the Z's, and do it that way. Okay, that's kind of the direction we're heading. But we need to set up the framework. Okay, so interest rate derivatives pricing. Classic example, option on a bond. So let's say we've got an option, we've got a bond. And we have T star. Okay, so we want an option on this bond which expires at T star. Okay, T star can never be more than Tn. Okay, because Tn is the maturity of the bond. The bond doesn't exist after Tn. So you can only write an option on something that still exists. Okay, but that's the direction we're heading. So we're going to have to do everything again. Okay, and I don't think it's a bad idea to keep going through the same concepts again. How many times have you seen me talk about pi, self-financing strategies, replication? Okay, but it is really the core of this module. This all has to be completely natural to you. Okay, now what you're tempted to do is this. Okay, this is what we done. This is what we did before. We said, let's have a portfolio, pi. In this portfolio, I'm going to put in my derivative plus this other stuff, which is my replicating portfolio, my replicating sub-portfolio. My goal always is to make pi 0 equal to 0, and then to ensure that d pi stays 0, right? That way no money comes in or out. This is my money market account. It doesn't matter that this is stochastic. Okay, it's still a valid thing. The problem is here. This is not a valid thing. You can't go and buy delta units of R in the same way you can buy delta units of a stock. Okay, you can't do it. So we're going to do something else. And this is very similar to what we did with stochastic volatility a couple of weeks ago. Okay? We're going to talk about, okay, this is the derivative, our target derivative. Instead, we're going to buy delta units of V1. And V1 is some other derivative. Okay? It's going to turn out that V1 are the Z's. Okay? But keep that aside for now. So you've got V and delta units of some other derivative V1 plus your money market account. Now that's a valid thing. You can actually go out and buy V1, whatever it is. It's an actual traded derivative. It is a chicken and egg scenario. Okay? We're trying to come up with a framework to price V, but we're doing it in terms of an asset V1, and we're making the claim that we know and understand V1, and yet we don't understand V. Okay? It's a bit weird. Right? But let's go with it. It's not weird. What we're doing is, actually, we're not eliminating arbitrage absolutely. We're eliminating arbitrage relatively. Okay? In other words, this framework will ensure that the pricing of V doesn't introduce any additional arbitrage that may already exist in the values of V1. Okay? That's all we're saying. Okay, so we start with a new model for R. And I'm going to keep it perfectly general. Mu and sigma are two drifts. Okay, so this will work for all models, but I'm keeping it perfectly general. And we have pi here. The idea is to keep pi 0 equals 0 and d pi t equals 0 for all t. Okay, it's what we've seen before. This is the self-financing strategy, which you've seen already. This comes as a consequence of pi t equals 0. Okay, you just rearrange it. It's just a convenient, we're going to use this later, it's just a convenient identity. This is also nothing new. We've seen it before. It's just Taylor expansion, preserving the second order term for Ito. Both v is a function of time. It's always a function of time, but it's always also a function of r in this case. Okay? So v can be a function of r. Okay? It's a derivative which happens to be it could be a complicated function of r, right? But it is some function of rt. Okay, and then we delta hedge. Do I have it here? Kind of. Maybe read the notes in this case. It goes in a little bit more detail. But remember, we delta hedge to remove the randomness. Okay, you've heard me say this so many times. We can't hope to meet this condition if pi has randomness in it. Okay, it's a non-starter. So we delta hedge. And you find out that you want to eliminate randomness, which comes from these two. So it's some ratio of those two guys, okay, with a minus sign. Turns out it's this, delta units. I'm going to introduce this operator, which is nothing more than shorthand for taking the first order derivative with respect to t, and then the second order derivative with respect to r. Okay, it's just to simplify the notation. If you go back here, do all of the calculus, rewrite the equations, do the delta hedging, what you end up with is this relationship. Previously, we had the PDE. Okay? Previously, at that point in Black-Scholes, we had the PDE. Here, we get a different result. We get everything on the left, which is a function of v, everything on the right, a function of v1. But v and v1 are functions of time and r. So we know that if these two are equal, they are both, what our framework is telling us, they are both some function of r, which I'm going to call a, of t and r. Right? What is a? I don't know. Okay, I don't know yet. There's nothing in my framework so far that tells me anything about a. I just know that mathematically that has to be true. But if it is true, then I can rewrite this PDE. A comes there. And this now looks very similar to the Black-Scholes PDE. Okay? Derivative with respect to time, derivative with respect to r squared minus rv equals 0. It all looks very familiar. Okay? So we can go a step further, find and catch, convert it to an expectation. Okay? Going from there to there we've seen that numerous times. So you can represent the solution to the PDE using an expectation, but it comes with a clause, right? And the clause is that the dynamics of R have to have A in the drift. Okay, this is like when in Black-Scholes we figured out that the dynamics of S had to have R. Okay, that just made the equation work, otherwise it's not valid. Okay, there's nothing magical in putting R in the drift. Okay, it's just something that comes out as a result. It says if you want to solve the PDE, go solve it numerically. Or if you're a star physicist, solve the PDE in closed form using PDE methods. And you can solve the PDE and get exactly the same Black-Scholes Pricer that we derived. The alternative is convert it to an expectation. But if you want to do it that way, I don't care what you thought the dynamics of S was, or R in this case, you need to use that drift. That's all that's going on. It's a mathematical result. Okay, so this is great. We have an expectation. We can price any derivative. Okay. VT can be anything now, right? It can be the price of the bond at time capital T minus K plus, okay? But this is a very complicated function of R because it's a function of many z's, and each z is a function of R. Okay, so it's complicated. And another thing is we can't take the e to the minus r out because that's also random. Okay? But if you want to think about it as Monte Carlo, if you want to think of it as a Monte Carlo, once you've got an expectation, you can really think about pricing things with Monte Carlo. Run a path for R. Okay? Once you've got a path, you've got e to the minus rt on that path. You've got all the z's. Okay? We haven't talked about how the z's come in, but essentially you can actually before I do that, let's go a bit further. Where does the A come from? That's the question. Okay, that's the question. Where does the A come from?
Fitting it according to V1, like operator on V1.
Yeah, sure. You can on V1, but what should we make V1? What is the simplest derivative we could think of? Even simpler than the European call option. What's that? Even simpler. The simplest. What is the simplest function of V that you can think of? 1, right? V equals 1. That doesn't get simpler than that. Well, V equals 0, but then, okay, that's not very useful. V equals 1. What is a derivative that pays V equals 1? Zero coupon bond. So we've just derived a framework to compute zero coupon bonds. Not that we need to, because they exist in the market, but that's the point. We have a framework to price zero coupon bonds, but we can observe their prices in the market. That's how we get A. We calibrate A to reprice zero coupon bonds. Okay. So let's do it with the Holy model. Okay. I hope the intuition is there. You've basically now got dynamics for R, which reprice zero coupon bonds. They are risk-neutral dynamics for R. You can now use those risk-neutral dynamics to price any derivative on R. Okay, no matter how complicated. It just becomes a mathematical exercise. It's no longer a question of economics because the framework tells you you've got your dynamics. All right, so let's start with the Holy model, which is this. And now I'm going to replace, previously I had mu, I'm going to make it A, right? And I'm going to drop the dependence on R because in the Holy model, A is only a function of T. It's not even a function of R. It's even simpler. So RT is that, and we're trying to work out that. Okay? I've said VT equals 1. And the idea is that we know what the price should be. We know the target price because we observe it in the market. Okay, so we turn the problem upside down, and the goal is to extract A. All right, the next part is maths. I'll go through it quite quickly, but you can go through it, and you should go through it in a bit more detail. Okay? We're basically here solving this term. Okay, that's what's going on. R is Gaussian, but we need to take the integral of R. Okay? So we get a double integral. That's why we have this double integral here. If you go through the maths, do a double integral, that is what we're claiming under our model is the price of a zero coupon bond. You know, maybe what I should have done to simplify it is made this T0. Okay? call all of these T0. This is also a T0. Now we know the bond. We've picked a bond, so we know the capital T, right? It's whatever we chose the bond to be. We know R time T0. T0 is today. We know the interest rate. We know sigma, because that was a model parameter. We know capital T. We know everything in this equation except for A. So we need to solve for A. Okay? And maybe it helps you take the log of S of Z. Actually, do I have it in the notes? I'm pretty sure I have it in the notes. Yeah. Okay, this is it. Right? That's our dynamics. This is what we're trying to solve. This is all of that. Okay? So go through it one line at a time, but essentially it's the expectation of the integral of RT. R is already given by this expression here. Okay, so you get double integrals. You might need to do some switch of integration, right? It's just calculus. I hope you can all switch the order of integration, but that comes up somewhere. Probably here, where we go from dw on the inside to dw on the outside. Okay, this is all just maths. It's not interesting. What is really interesting is that you eventually get to this formula, which we had. We can take the log to get rid of that exponential and just solve backwards for A. Okay, and what you get is that A is just this function. Sigma times T, that's a linear in time. If you could fit, okay, now what do we see in the market? In the market, we see Z as a function of capital T, right? We can see a 1-year bond, a 2-year bond, a 3-year bond. Let's fit some nice curve to it, right? A curve where if we take the log, we can take the derivative with respect to capital T. That's all we're doing, right? It's just mathematical machinery. The point is that we've extracted A under the Holy model, right? We're only looking at a specific model. We've extracted A, which is nothing more than a function of time, and for now I'm going to keep it as a function of time. And once I've got that, I know this. Okay? I know the risk-neutral dynamics of the short rate. Now that I know the risk-neutral dynamics of the short rate, I can start thinking about other derivatives. Okay? Another question, what's the next level that we can think of? The simplest derivative is a zero coupon bond, right? And we priced that, but really, we didn't do it to price a zero coupon bond. We already know the price, right? It's in the market. We did it to calibrate our model. What about an option on a zero coupon bond? We probably don't have that in the market, but we have a model. Okay? So now you can think of it as, right, I want to price an option on Z. What are the dynamics of Z? This is the expression for Z under the model, right? Under all this messy maths. Ultimately, it turns out that Z follows, well, this is the expression for Z. Okay? You all agree that Z in the future, we know Z today, but Z in the future is a random thing, right? Z is a function of time, little t, and it evolves randomly. Okay, where does the randomness come from? Do you see it? A. Why A? A is just a function of time, right? We've identified it. We've got A. The rate is random, but I guess what I'm asking is, we're trying to now extract, we want to price an option on Z, so we need to understand the distribution of Z. And can you tell by that, from that chart, from that equation, what is the distribution of Z? Right, it's log normal, because no, A is just a function of time. R is Gaussian, right? So this thing is F little t measurable. Okay? In the same way that S, stock price, is little t measurable, right? This is a constant. This is all just a function of time, but it's also constant, deterministic. This is deterministic. The randomness comes from here. And what do we know about R? It's Gaussian, right? The two models we introduced today are both Gaussian. Exponential of a Gaussian is log normal. Okay. So we see the result, and that's promising. So I'm going to try to derive dz. Okay, this is what I said earlier on. Why didn't we just do this from the start? Okay. So I'm going to write down all of this in here. This is all just mathematical machinery. I'm going to write that all as that. Okay. I'm going to try to figure out d of psi. Okay. And I'm going to use Ito. So I take the first derivative with respect to r, keep the second derivative with respect to r. I'll let you go through it. Okay. It turns out to be this guy up here. And we want z. We know that z is just this term, right? So I'm trying to work out dz, and I'm using dz by d pi phi plus a half d squared z. Okay, that's what I'm using. And after all the maths, go through it slowly, you get this result. Okay. It looks very similar to what we would have expected. R times Z, that's the drift with the risk-neutral rate, plus sigma times this additional term, but essentially it's log normal. Okay, Z turns out to be log normal with log normal dynamics just as well, because this whole module is about log normal distributions. But if it's log normal, we can solve it. Okay? What's interesting, what you notice here, okay, capital T is fixed, right? That's not changing. Little t is changing. What's happening to the volatility as time little t goes to capital T? Volatility is going to 0. Why is that? Yeah. Because, well, what do we know about Z at time capital T? It has to be 1, right? This is what is called the pull to par effect. Okay? The pull to par. So at time capital T, we know that the value of the bond is 1, and the volatility has to go down to 0. Now that's a result that we might have missed or not captured if we just gone in day 1 and said, you know what, I want the dynamics to be so and so. Okay, but it just fell out. Okay, so Z is log normal. That's good news. I now want to price an option on a 0 coupon bond. An option which expires at time t star on a 0 coupon bond that matures at time t. Okay? T star has to be below t. And risk neutral valuation tells me it's still that expression. Okay? So the expression looks no different to what we had before. Solving it is a lot more work. Okay? Because this thing is random. Okay? This thing's random. They're both jointly random. They're driven by the same Brownian motion. Okay? So solving this thing, if you're looking at it and trying to do it in closed form, is very, very messy. You probably could do it, but it's very, very messy. At least if you think about it conceptually as a Monte Carlo, what are you going to do? Well, you're going to simulate R using A as your drift, all the way up to T star. That gives you the first term. Once you're at T star, you've got R star. You bung it into this formula, the one that we saw. Okay, this one here. You've now got z at t star on that path. You compute the payoff, do the multiplication, repeat 10,000 times. Okay? You could at least do that. At the very least, you could do that. Now, it's beyond the scope of this course, but nobody would solve it that way because you can actually do it in closed form, but nobody would even solve it like this in closed form. You'd have to invoke something called the forward measure. You basically simplify a lot of expressions. Instead of having this term, you somehow introduce z0 t star on the outside. It's beyond the scope of this course. For now, I just want you to understand the idea of calibration. And once you've got the dynamics, you can do a whole bunch of stuff with it. Okay? What if you now wanted to price the option on P? Remember, P was this fixed coupon bond which depended on many different Z's. Okay? Well, it's just a function of a whole set of different Z's for maturity Ti, right? But each Z is a function of the same Gaussian variable. Okay? If you're simulating to T star, all you care about is R T star. This is what it means to be a one-factor model. It means all your Z's depend on the same Gaussian variable. Okay? Where Z is some underlying O1 variable. Okay? All randomness comes from the short rate. Again, think of it as a path. You simulate, if we were doing P time T star for a bond that matures at time T. Okay? And of course, I've left out the important part, which is that you have okay, you've got that. If you're trying to do this, you just simulate R up until time T star. Well, you've got the path, so you can compute the exponential. Now you've got R at time T star. And all bonds depend on R at time T star. Okay? Because P depends on a whole bunch of bonds. But all of them have this unique feature that once they're all T star measurable. Okay? Which means that once you've got R at T star, you've got all of them. And then you can solve that. Okay, that's in a Monte Carlo, but really it's a 1D integration problem. That's the point. Okay, we started off with dynamics for R, which only had one Brownian motion. That Brownian motion has to be the sole driver of all the randomness in our process. It's heavy, I know. Okay? But this is it. The fixed income is a multi-dimensional problem. And this is the issue now. We've done a lot of work to solve things in one dimension. Okay? All the Z's are driven by a single Brownian motion because R is driven by a single Brownian motion. Now think about how, if you were to simulate a portfolio of bonds, and you're just trying to do some scenario analysis, like let me see, I've got a portfolio of bonds, let me see how the value of this portfolio could change over the next year. Okay? And you do a Monte Carlo. What you'll find is that all the bonds go up and down together. They're all driven by the same Brownian motion. And that's not realistic. Okay? You might see a rally sell-off, okay? So they all move together, so that's okay. Your model can handle that. But what you see very often, and you see it now, today, but you saw it a lot in 2023, is that short-term bonds don't move the same as long-term bonds. Okay? Short-term yields, because a bond and yield are proxies for each other. And short-term yield means short-term interest rates. They don't move the same as long-term interest rates. Okay, so say you have two bonds, T1, which is a 1-year bond, T2, which is a 10-year bond. Okay, bonds and fixed income go out to 30 years, so 10-year isn't really all that far out. How do they move together? Well, under this model, they both move up and down together. If one moves up, the other one's going to move up. Okay, because the same Brownian motion driving them. But what you actually see in the market is instances where the short end moves up, but the long end moves down. Okay, that's what's called a steepening of the yield curve, or a flattening in this case. Steepening would be short end doesn't move much, but the long end goes up. Okay, and the 10-year, 2-year Treasury yield spread, I don't know if this link is still valid. No, I don't have it here. But if you plot that spread, you see it moves massively over time, okay? Which means that the yield curve doesn't move up and down together. It kind of does, it's got a very weird shape. And that means any serious interest rate modeling needs a multi-factor model, okay? No surprise, we have many bonds in the market. They don't all behave the same. There are some commonalities, but each bond could have its own idiosyncrasies. Okay, so you need a multi-factor model. And it's beyond the scope of this course. But we have things like HJM, Heath-Jarrow-Morton, or the BGM model. These are multi-factor models which allow you to model the yield curve in a way that you can have scenarios where the yield curve in the short end goes up, long end goes down, or vice versa. Or they both go up and down together. Okay, so 1D, even though we've done a lot of work, it's complicated, it's just an introduction to the concepts. Okay, we couldn't really use it. We could use it if we were just pricing one bond, an option on one bond. We don't care what happens to the yield curve, right? We're pricing one point. But if we have a portfolio of bonds, if you're a money manager and you bought short-dated bonds, you bought long-dated bonds, and you want to understand how this portfolio could move with time, well, you need to account for the fact that maybe the short-end bonds won't move all that much because everybody's very clear about what the central bank's going to do for the next year, maybe less clear over the next 10 years. Okay? Any questions on that? All right, I want to leave pricing there for now. So we've introduced dynamics, we've introduced the pricing framework. It turns out on the surface, just like FX, it looks like it's the same problem. You've got the same expectation. You've got a discount factor, e to the minus RT. You price an option, it's price minus K plus. That's how powerful risk-neutral framework is. They all look the same. But under the hood, the machinery is different. Okay? And today you saw it quite substantially, because just to get to that stage, we had to do quite a lot of refactoring of our earlier derivations. All right, different topic, if there are no questions. Right, so these are our underlying assets. Okay, they're all available. And I'm going to assume for all capital T. Even if the market doesn't trade a bond that expires on the 30th of June 2027, I'm going to assume that I can interpolate between two that do, and I've got that price. Okay, so we've got a whole bond, a whole continuum, a whole yield curve, or let's call it zero curve. Okay, I've got the whole zero curve. And if I plot the yield, function of t, it very often looks something like that. Not always, but typically. Okay, so let's say I set up this special portfolio. I'm only talking about two times now, T1 and T2. Go T1, T2. And I'm going to set up this portfolio where I'm long the T1 bond, and I'm short alpha units of the T2 bond. Okay? And I'm going to pick alpha to just be this ratio. Okay? What is the value, what is the price to set up this portfolio? Okay, 0. Cost me nothing to set up that portfolio. But how does the portfolio behave? What happens at time T1? Well, at time T1, that bond is still alive, but this one's matured. I'm long that bond, so I receive $1. Okay, and then I wait till time T2. At time T2, I'm short that bond. I'm short alpha units of that bond. So I've got to pay out alpha. Okay, so at T1, I receive $1. At T2, I pay back alpha. So effectively, I've synthesized a loan. Okay, that's what a loan is. I kind of lock myself in so that I'm going to receive $1 at time t1, but then have to pay back alpha at time t2. And alpha is greater than 1. Okay? Alpha minus 1 is the effective rate of interest. It's not the rate of interest, it's how much interest I've paid. Okay? But the important thing is T1 and T2 are in the future. T1 might be in a year, T2 might be in 3 years. Okay? I've basically locked in today a loan for the future. I've locked in the interest rate today. Okay? So this thing is called a forward interest rate. Okay? If I had $1 to invest today, how would I invest it? I wanted to invest it for a year. I'd go out and buy a 1-year zero coupon bond. Okay? How many could I buy? I don't know, say the zero coupon bond is trading at 0.9. 1 divided by 0.9, I get 1.1 units of zero coupon bond. Cost me $1 today. In a year, I get 1.1. I've simulated a loan, a reverse loan. It's an investment in that case. That's exactly what's going on here. We're using the existing prices of zero coupon bonds to lock in a forward rate of interest. And this is the fancy expression for that rate of interest. Okay, just rewrite it. It's the forward rate that you can lock in at time t0 today for some forward period from t1 to t2. And it's a function purely of the zero curve that you observe today. Okay? You come in tomorrow, you'll get a different number. Okay? But you've already locked in your rate. If you did the trade today, you've already locked it in. So people monitor this every day. Companies that know they have funding requirements, they know they're going to need to build a new power station in a year, and it's going to take them 5 years to build, so they need the loan to cover them for 5 years. Okay, they monitor this every day. As soon as they get a rate they like, they lock in. Okay? It's a forward rate of interest. Now let's take the case. So T1 is, T2 is equal to, I think this is the case we have now. And then we take the limit. Okay? So I'm just taking the limit as the two dates converge. This is called an instantaneous forward rate. Okay? It's just the limit of how much you can borrow overnight for some period in the future. Okay? So if S is 1 year, it tells you that if I want to borrow money in a year for one night, that's how much it would cost. And it introduces this nice notation. Okay? It's an analogy to the short rate. F here is called the instantaneous forward rate. It looks very similar to the e to the minus RT. There's no expectation. Okay? Here we're integrating with respect to S, not T. All right? Earlier we were integrating with respect to T. So we needed to do an expectation. Think of it another way. F basically contains all the information on the yield curve, the zero rates. Okay? And you can always retrieve from those zero rates the price of a bond today. Okay? It's just an inversion of the formula above. Any questions? All right, the next two slides are not terribly important. We're starting to wander off course now in terms of this module, but we got this far, so I'll give you a little bit more. Okay? We've seen a fixed coupon bond. Right? So fixed coupon bond, dates in the future, you get C%. That's it. C is decided up front. With a floating coupon bond, the interest rate you get for this period is the rate you can lock in. Let's call this Ti minus 1, Ti. Is the rate you can lock in at Ti minus 1. That's like me saying today, well, how much interest can I earn today? Well, I look at zero coupon bonds today. If I'm interested in locking it away for a year, I buy a zero coupon bond for 1 year. What rate can I lock in the future? Well, I have to wait till this date. Look at what the zero coupon bonds look like on that date, more specifically the 1 year zero coupon bond on that date and figure out what rate of interest I can get. Okay? It's stochastic because these bonds are going to move randomly between now and then. So that's a floating rate note, right? It's basically a bond that pays you a floating rate coupon. But what do we know about the fair value of that forward rate? Okay, we know it's stochastic, but we know that there's a fair value. And the fair value is the forward rate. Okay? If you wanted to replicate that coupon today, if we wanted to estimate what is the fair value of this coupon today, well, the best we can do is the forward rate for that period. Okay? So it turns out that the floating rate note, and it's a bit messy to show this exactly, but essentially that floating rate coupon is given by this quantity here, okay, seen as seen today. And if you rewrite this, so previously we had, okay, if this is getting too much, don't worry, this is more complicated. But previously we had C. Okay? Now we've replaced it with a floating rate. Okay? So each coupon is no longer some fixed value C, it's some random quantity, but we're saying that even though they're random, the fair value of that randomness is this forward rate. Okay? So if you open up all of these terms, what you notice is, this term will cancel that term. You'll get a Z T0 Ti minus 1 minus Z T0 Ti. Taking the sum over all I, a whole bunch of these middle terms will cancel. Okay? You end up figuring out that a floating rate note just has value 1. Okay? It turns out that a floating rate note, even though it's paying out a coupon that's random, it has a value of 1, always. Okay, so the mathematics, that's what it tells you. And that's why I don't want to pay too much attention to the maths. Okay, I just want to reassure you that the maths agrees with it. But think economics. How would you replicate a floating rate coupon? Well, we've already talked about how we would replicate an investment starting today for a year. You take your dollar, you buy the bond that matures in a year. What happens in a year? You get your dollar back plus some interest. The interest is the floating coupon. What do you do with the dollar? You buy another bond. Okay, you do the same thing again. In 2 years, you've got another rate of interest, plus your dollar back. Pay back the interest, get your dollar again. You just keep doing it. You see, all you need to replicate a floating rate coupon is $1. Okay? Economically, you see that that's how you would act. This is just the mathematics showing it. Okay, so floating rate bonds are not really all that interesting. Okay, that's the takeaway. That's why this is not going to come up. Fixed coupon bonds are interesting. Think of it another way. With a fixed coupon bond, you bought it on day one. Remember the 3% bond? You bought it, you felt good about yourself. Half an hour later, the bank raised it to 5%, and you're cursing, right? You're cursing because you locked in a rate of 3%. Would you have been cursing if you'd bought the floating rate note? No, because you're going to get the new enhanced rate. Whether it's 3%, 5%, whatever it is, you're getting the fair rate, the one that's set by the bank, which is why the value is always 1. That's another way of thinking of it. Okay, this is kind of what I've described here as something, this rate from Ti minus 1 to Ti, if Ti minus 1 to Ti is 3 months or 6 months, used to be called something, a LIBOR rate. Have people heard of LIBOR? It's a very, very popular interest rate up until about 10 years ago. And there were big scandals around it, and they canceled it. They replaced it by something called OIS, but now instead of 3 months, it's daily. But really the same logic extends. Okay, so I'm not going to go through this. The same result is still valid. It's value 1. Now, instead of buying a bond for 1 year and doing everything every year, you do it every night. Okay? You take a dollar, invest it overnight. Tomorrow, you get your dollar back plus a little bit of interest. Okay? You take all of it together, reinvest it again. Your money basically just keeps growing. And it's only after a year that you withdraw the interest and keep your dollar and start again. But going off course now. Okay, I'm actually going to stop there. Zero curve bootstrapping we can talk about next week or on Thursday. Any questions on any of the material today? This is a 101 on interest rate derivatives, really. We've talked about the basics. What is interest rate? A bit of macroeconomic background. And really, all of this always comes down to macroeconomics. What's happening with the Fed? What are the central banks doing? It always ties up to what's happening with inflation, what's happening with the economy. That's what drives interest rates. And that's what drives the randomness in interest rates. So you need to understand a bit of that background. And then you've seen 2 or 3 common models, Holy, OU model. You should know how to solve both. Realistically, in terms of mathematics, that's as far as you'd go. You would never be asked to derive the PDE in an exam. I don't think it, other than memorizing, I don't know what it would test. It's just messy mathematics. You can't solve the expectations because you've got 2 randomness terms. It's too complicated. You could be expected to write an algorithm, but in terms of mathematics, derivations, limited in terms of what we could cover. Be comfortable with the idea of a forward rate, for sure. In the same way that you're comfortable with the idea of a forward volatility and forward rates in general, forwards on stocks, forward FX. Any questions? Anything?
When we are saying that rate is like we are fixing a rate, what is its compounding period like? Is it continuously compounding?
Which rate are we talking about here? Which slide was I on? Every rate.
Yeah.
Oh, the short rate. Okay, so okay, that's a good question. And the clue should be here. Because we derived the risk-neutral dynamics.
That implies it's continuous.
That implies it's continuously compounded, which implies that R is that's what a short rate is. A short rate, which is also called an instantaneous rate, or instantaneous short rate, it's precisely the rate of interest that accrues according to this. So if you take out the minus, that's how the bond money market account would accrue. So it's a continuously compounded short rate.
Can you go to the slide where we said like the par value? There is a delta term for this.
Delta term.
Like any slide that is there is a
Delta in.
Even the forward rate, it is like 1 upon delta.
Okay. Yeah.
The delta there.
Okay, this delta here. Okay, now we're talking about. Okay, these are very good questions. Okay, so here we talk about T1 to T2 being a period in the future. Let's say it's 1 year. Let's say T1 is in exactly 1 year, T2 is in exactly 2 years. So T1 to T2 isolates this 1 year period that starts in the future. Okay? What have we done here? We've synthesized a loan where you're going to get $1 on the 1st of January 2026 and repay it 1st of January 2027. Okay? And you're going to pay alpha. This is what alpha is. Okay? In this case, delta would be 1. Right? Because delta is maybe you're right. I haven't made it clear. Delta is T2 minus T1. Okay? Delta is T2 minus T1 in this case. So in this case, the forward rate is an interest rate applicable is an annualized forward rate from T2 to T1. Let's take now the case where T1 to T2 are 6 months apart. Okay? And let's say interest rates are around 5%. Okay? They're 5% forever. So we get the numbers. If I go back to my first example, T1 to T2 is a year apart. This will be a roughly 1, okay? Or exactly 1, depending on the day count fraction. This whole thing will come out to be around 5%. Okay? If I now make T1 to T2 6 months in the future, this whole thing, this part, will come out to be around 2.5. This is a half. So this scales it up, makes it an annual interest rate. So you'll still get something that looks like 5%. But it's 5% applied as an annualized rate for a 6-month period.
Okay, so this forward rate is more of an annual, right?
In this case, yes. In this case, it's an annualized rate. Okay? Because it's always an annualized rate. I think you need to distinguish between the units of interest rate and the period that we're talking about. Okay? I can pay you 5% for 1 year with annual compounding. Okay? Or I can pay you 5% for a year with continuous daily compounding.
That will be much more.
It'll be a little bit more, yeah, because you get interest on interest. Okay? But my point is that in both cases I talked about 5%. That's the annualized rate.
But aren't those two values different?
They are different, but they're both annual interest rates. So in one case you might have 5, in the other case you might have 5.1.
Oh,
Okay? The numbers are different, but they both represent annualized interest rates. What's different is the compounding.
so effective rate is different,
What is effective rate?
like the amount of money I'm getting.
Yes, correct. Effective rate will be different. And in fact, the effective rate under these two accounts should be the same. If you invest 100 in one or two, you should end up with the same,
Yeah.
right? Different rates of interest. The number is different because they both compound differently, but they will grow to the same amount in 1 year. Yeah.
So that is like the time duration. Delta represents the time duration, right?
Yes. The term for the loan. Think of it as the term, yeah. The time period, the time window you're looking at.
So in the formula for pricing of the value of the bond, there is like summation of C, in dot delta, like it's way up.
The fixed coupon bond.
Yeah, fixed coupon.
Yes.
There is a delta I.
This one here, right?
Yeah. Oh, sorry.
This one or no?
Yeah, this one.
Yeah, so again, let's think of it, let's keep it simple for a moment. Let's say the coupons pay every year. Delta is the measure of the time period between coupons. Okay, so delta in that case will be roughly 1. Let's say it's a 5% bond. So C is 5%. So every year you're getting C times whatever the notional is, right? $1. So you get 0.05 every year.
So that means the units of my delta should match this rate I'm using. Like if 5% is my annual rate, then units of delta should be like yearly. Like
Yes,
1
yes,
year
yes.
for 2 years.
Yes.
If it's monthly, then it should be like 12, 20.
Okay, so if it's monthly, or let's take semi-annual.
Yeah.
Okay, semi-annual. Now T1, so now my time periods are 6 months apart. Okay? I'm paying 5%. C is still 5%. Okay? What is the actual physical coupon I get? I get 5% times 1, whatever the notional is, times delta. Delta in this case is half. Okay? I'm only going to get half of the 5% because I'm only getting it for the 6 months. Okay? I'll get another 2.5% the following 6 months.
So the key is that the rate you're using, 5%, that is annual.
Always annualized. Yes. Yes. The delta, either little delta or big delta, adjusts for that's why it's called a day count fraction. Okay? If it's 1, you're kind of looking at a year.
It's similar to F in continuous compounding,
F in continuous compounding,
right?
you mean?
The delta, the low delta.
Here. This one here?
Yeah. Could it be likened to that?
So, yeah, it's very similar. It's basically this, the delta here adjusts it. If you just took, let's say we're back to our 6-month period, T1 to T2 6 month. If you just take this part, leave that out. If you just take that part, you'll end up with 2.5. But what you're saying is I'm getting 2.5% for 6 months, which annualized is 5%, right? But we always talk about interest rates as an annualized number, a metric. Same here. I took the limit here, delta goes to 0. Okay? Here I took the limit, delta goes to 0. F is still going to be a number that looks like 5%. Okay? It's an instantaneous rate. It's a rate that I can apply for one night only, but on an annual basis, it's 5%. I'm not saying I'll get 5% for a year. I'm saying I'll get 5% for one night. But 5% is the annualized number, right? Otherwise, you're going to have to always mentally adjust. Is this interest rate for 6 months? Do I need to double it? Right? This side is very quiet. Any questions? Okay, so we have one more session together. In that final session, we'll talk about credit. We've got a little bit more to wrap up on interest rates. I'll give you a little bit of prep, I guess, for the exam. But it's nothing that I haven't said already, right? The exam is closed book, no cheat sheets. All you need is your pens, papers, a scientific calculator. You'll have booklets to write in, so we will provide the booklets. Maybe important to bear in mind, you'll get 2 booklets, and there'll be some instructions. You need to write down solutions 1 and 2 in one booklet, and 3 and 4 in another booklet. The type of questions, 4 questions in total. Each question will have multiple parts, and each of those parts are closely related. Each question is basically one topic. And the idea that you need to demonstrate is understanding, right? It won't be like the multiple choice where there's a right or wrong answer. Even if you get the wrong answer, if your reasoning is good, you'll get the points. Okay? And look at the number of points for each part. Okay? The number of points tells you how much work you need to put in. Question with 2 marks, okay, we're not looking for much. Question with 8 marks, you probably need to put in a lot more thought. Okay? But anyway, we'll talk about more of that later. For now, I guess we can finish a little early, unless people have questions. Okay, see you on Thursday.